We have historically wide spreads in our markets. We're running very conservatively, and we sleep well at night, and hopefully our investors are as well, while clipping their 13% dividend yields. So with that, I'll stop. About 10 minutes left. Hopefully we can have some dialogue. I know Calvin has about 40 questions for me, but thank you for your time.
Thanks, Jay. I've got a couple questions, and I'll try to leave some time at the end for the floor. The first question that I would have is about your leadership. You commented on having experienced and stable leadership, and those of us who've worked with Annalee have been concerned about Mike Farrell and his condition. We're glad to see the press release and the news that he's completed his cancer treatment and is in remission. But could you comment a little bit about what his role is now and likely to be, and also how the rest of the leadership team has been handling this?
Sure. I couldn't agree with you more. We were very happy that Mike's cancer, which was caught early and was treatable, is now in remission. His hair's starting to grow back, which is good too.
Mine's not.
Funnily enough, it's coming in gray. It wasn't gray before. So we haven't asked him about that. But our management structure has always been relatively flat. Mike and Wellington Dennehan, our vice chairman, founded the company together. They've had a predecessor company started in 1994, and they've been together ever since then. Very strong team around them, myself included, and we all oversee the various parts of our business, whether it's the liability side, the asset side, the asset manager side, capital markets, and all of these folks stepped up and played their roles as they always did while Mike was receiving his treatment, and are only continue to do so. Investors should feel confident that with the experience of our team, many of whom have spent their entire careers at Annalee, will always be around, even if that day comes when Mike is no longer at the helm.
Okay, well, thanks. I'm glad to hear that news, both for your company's sake and also we express to Mike our wishes.
Sure.
Second question, you talked about the depth and liquidity in the repo markets and the counterparties, but another important part of your business, of course, in the hedging markets, the swaps and swaptions. Could you talk a little bit there about the depth and liquidity, possible fragility, given what's going on in Europe in the treasury market?
Sure. So just from a macro sense, the depth and liquidity of the repo market for agencies couldn't be deeper. If you think about looming changes in capital rules, aversion to risk, flight to quality, the assets that we own are highly prized. And because of what's happening to sovereign ratings around the world, AAA assets are getting scarcer and scarcer. And yet there's all this cash out there that needs to earn a return. They can put it into a money market fund and earn a basis point or two. They can't put it on deposit because banks can't take them. They can go out the risk curve, but a lot of those money managers can't do that. So they turn to the repo market, released on an overnight basis. They can get 20 or 30 basis points, and if they want to extend out a little bit more, they can get a little bit more of a return. So the repo market is deep and liquid. Haircuts are stable. The terms and conditions we get from one lender are essentially the same as we get from any lender.
How about in swaps and swaptions?
Well, we're not involved in the swaptions market, but the swaps market is equally liquid. We tend to focus our exposure there to a smaller universe of counterparties. It's a different type of transaction. So whereas in the repo market, it's a bankruptcy remote transaction, and even in the event of a bankruptcy, if you're a borrower in the repo market, you get your cash back, or you get your collateral back, and the lender gets their cash back. Swaps a little bit different, so we tend to only do our swaps with reputable, large money center banks, and again, that readily available.
Okay, this is going to be my last question, and then I'll turn to the floor. And so there's a follow-up there. Could you talk a little bit more about your first quarter results? You had a good increase over a year ago with $900 million versus $700 million a year ago. A bit of an increase in your net interest income, but again, actually, a large contribution from your swaps, your hedging position. Could you just give us a minute or two color on the first quarter and then how you see Q2 shaping up?
Sure. Well, like I said, what we try and do is with the swaps position, is you're hedging your interest expense. The way portfolio like ours work, our liabilities will reset generally quicker than our assets will. So we try to lock in spread with our swaps. And this is insurance, obviously. If rates aren't moving up, you're paying for insurance that you don't use. It probably costs us 25 cents a quarter for a swap position. So if we're totally unswapped, you can imagine what our returns would be. But obviously, we'd be at a lot of risk if we did that. The main drivers of our returns are always going to be the shape of the yield curve and the amount of leverage we use at its most basic level. And the swap, the spread in our book right now is about 170 basis points. So leveraged around 6 to 1, you can see how that gets to around a 13% return. That 40% of our book is swapped out. So in the event that rates do rise, you'll see that a lot of that spread will be maintained. But then you also have to remember that as part of your book's portfolio spread is compressing, you're also reinvesting into the new interest rate environment. The thing to remember about any financial statement for a firm like ours is that quarter ends are a snapshot in time for a portfolio that is not static, unlike a traditional bond portfolio, obviously. The duration of our portfolio changes every day based on market moves. The leverage in our portfolio, we don't do a single thing, can change every day based on mark to market. Our portfolio is mark to market. Our book value is a mark to market book value. So these things are changing all the time. So what investors should understand is that as these cash flows come in every month, we're reinvesting into whatever the new interest rate environment is. And our decision to reinvest cash flows, whatever we want to buy, or whenever we want to sell and harvest gains. If we think prepayment speeds are going to pick up immensely and we have a bond that's marked at 106, it pays off the par. So we're going to lose that mark. Even if we bought it at 102, we're going to lose that premium. So there's a constant decision-making process that's going on in portfolio management of a leveraged mortgage-backed security portfolio. Again, it's the experience of the team that we have that's been through all these interest rate environments that I think is what investors should be asking questions of, both for us and for any other mortgage REIT in the space. Is how have you performed through these different interest rate environments? How did you perform during the seize-up in 2008? Very important question. How did you perform during the two-year tightening campaign at the Fed from 2004 to 2006? How did you perform during the great refi wave of 2003? What we have today is nothing compared to 2003. These are questions that I think any portfolio manager that you speak to for a mortgage REIT should be able to answer.
Thanks. Why don't we take a question? We have about 5 minutes left. Question right here.
You would alluded to it, but something's going to happen with Fannie and Freddie, and I wonder what your thoughts on that are. And if they hadn't been bailed out, what would have been the effect if the model would have worked?
Well, if they hadn't been bailed out, I think China would have declared war on America. There's a lot more people that own agency MBS and debentures than just Annaly Capital Management. But you're right.
Let me just interject, since this is being recorded. The question was about Fannie and Freddie. How does that affect the market environment and if they hadn't been bailed out?
Yeah, and look, the first 15 minutes of every roadshow presentation or meeting with investors from 1997 to 2008 is what would happen in the event Fannie and Freddie ran into trouble? And the answer was always, there's that backstop from the U.S. and they will never back away from it. Now there's different questions, but that question I think has been put to bed. Now the question is, what happens going forward? And look, I think if Fannie and Freddie weren't around, the federal government would have tried to create them. In fact, you do see other countries around the world asking a lot of questions of our agencies about how a government guarantee works in the mortgage market. Other countries have mortgage markets that varying degrees of success, and housing markets that are also varying degrees of success, but they're constructed completely differently. The lion's share of mortgages in the United States are held in securitized form. Most of them have been guaranteed by the federal government through Fannie, Freddie, or Ginnie. In European countries, most of residential mortgages are held on bank balance sheets or in covered bonds, where the ultimate credit is still going to be the bank. Banks aren't as strong in Europe as they used to be, and they're starting to look at this particular model. I think the eventual outcome will probably be something that looks a lot like we have today, where there will be a government guarantee. That's the way to guarantee that rates buyers continue to fund residential mortgages. It just might be delivered through a different form.
Okay, and this question halfway back there.
So just curious on your view on HARP 2.0, the perceived effectiveness of that program, how you may be positioned against that.
Sure. The question is, how are you positioned against HARP 2.0?
Sure. Look, that's the big wild card in the market. If left to rates alone, in a normal market, prepayment speeds would be a lot faster, but they're not as fast as they otherwise would be because of all the frictions that are in the marketplace. Negative equity, credit availability, credit standards have tightened up. There really is very little securitization outside of Fannie and Freddie. So rates alone have not generated the types of prepayment speeds that otherwise would be in place. The big question mark is whether or not government-mandated refinancing programs are going to change that. Up till now, they've been relatively ineffective at achieving the goals, the policy goals of the administration. That doesn't mean that if things get worse in the market, they won't try to do more. I will also say we probably haven't seen the full effects of HARP 2.0. You'll note the MBA Refi Index, which came out this morning, showed one of the largest week-over-week increases in a couple of years in a week in which mortgage rates actually went up. That could be related to HARP. It could be related to the fact that the prior week was the Memorial Day weekend. We don't know. But we're on guard for faster prepays. And again, the way we manage that is through asset selection. You can buy securities that have call protection, if you will, loan balances, already HARPed bonds, and the like. And when you try and protect yourself by having relatively little premium in the book, i.e., do you want to buy a Fannie 4 at 106? We feel uncomfortable buying bonds with very high premiums so that our portfolio in the aggregate will have too much premium in it.
Thanks. We have a bunch of questions left, but we're out of time. I'm sure Jay will stay here afterwards, but we're going to need to get the room ready. So again, thank you for the presentation and thank you all for attending.
Thank you.